Hi, welcome to this podcast initiative of SBI Mutual Fund, where people from our fund house speak about how they work, their investment philosophies, and what they are doing on the fund strategies they manage. I'm Rohit Shimpi from the investments team. I've been with the fund house for over 10 years. Apart from investing, I also enjoy music, books, and cars, but this is a show about investing. So let's begin. Joining me today are R. Srinivasan, our head of equities, and Anup Upadhyay, our head of research, to speak about the SBI Magnum Global Fund. Welcome, Vasan and Anup.
Hey Shin, thanks. Wonderful to be here.
So before we start, a strong disclaimer for those listening. This is not a sales pitch or a prompt to entice you to buy the product. This is just about familiarizing you with the fund, the managers, and more importantly, the investment process behind it. Mutual fund investments are subject to market risk. The past performance is no indication of future performance, and also please read our offer documents carefully before investing. Now back to Vasan and Anup. Vasan, can you start with the basic investment philosophy for the SBI Magnum Global Fund?
Sure. So Magnum Global is, we run it as a quality midcap strategy focused on generating above average returns from a 3 to 5 year plus perspective. So the key words clearly are quality and midcap. The quality focus lends a long-term defensive flavor to the portfolio, and midcaps, I think, increase our ability to generate above average returns relative to popular benchmarks like a nifty or a sensex. The fund is run from a bottom-up perspective. It's 90% invested at all times, and a very important disclaimer: since the fund focuses on quality stocks and is kind of benchmark agnostic, it is not meant to be consistent against the benchmark, which is the midcap index.
Okay, so why did you embark on a quality philosophy, and since when have you been running it this way?
Oh, we've been doing this since 2009, maybe early 2010, I think. That's close to 7 years. Anup, do you want to take that question on why quality?
Sure. This was around the time when we were creating clear identities for our funds. Quality investing seemed like a very natural thing to do. Great companies, like great cricket players, have certain sticky characteristics that allow them to keep outgrowing mediocre companies over multiple business cycles. Batsmen with strong batting technique, like Dravid or Tendulkar, could outscore others across countries, seasons, or pitches. We define quality in terms of 1. A right to win characteristic, 2. Returns on capital, and 3. Growth.
Yeah, so growth is kind of part of our quality definition. That's important to note, right? Sorry, Anup, please continue.
Yeah. Then we did a back testing of this philosophy. Actually, the last 2 factors, since the first is qualitative. And we found that it works pretty well. While it wasn't very consistent on a year-to-year basis, we found that the extent of outperformance far exceeded the extent of underperformance, leading to a meaningful cumulative excess return.
Yeah, I must say it has done pretty well since then.
Yes, it has. But that is also due to the fact that quality as a philosophy or category has done pretty well in India, in emerging markets, actually across the world. So to put it in perspective, the large cap quality index and the mid cap index have outperformed the nifty by about 50% cumulatively since 2009. And we have outperformed both the quality large cap and the mid cap index by 100% cumulatively.
Can you elaborate a bit about how you go about picking stocks?
Yeah, so we essentially screen the universe for quality, which is return on capital and growth. This could be historical or expected return on capital or expected growth. Typically, we're looking for around 18 to 20% on both return on capital and growth. We also run a qualitative screener for a right to win characteristics or comparative advantage. So we generally had about 150 to 170 stocks in the investable universe that qualifies for quality and growth. Then we look at management quality and valuations, and based on the intensity of the quality factor, construct or rather maintain a portfolio of around 35 to 40 stocks. There are obviously additional risk controls that are built into portfolio construction, such as a maximum active sector weight of not more or less than 10%, an active stock weight of not more or less than 5%. And the process also involves, and this is important, a detailed qualitative discussion on comparative advantage, which involves me, Anup, the relevant analyst, and anyone else in the team who's interested. Anup, do you want to talk about how we define competitive advantage?
Sure. Competitive advantage is just another word for what Warren Buffett used to call economic moat. These are essentially characteristics that put the company in a superior or advantageous position relative to its competitors. There could be various sources of competitive advantage. Google for economic moat and you will get a host of stuff. We have identified, and there is nothing proprietary about it, 7 sources of competitive advantage, namely cost competitiveness, market share, brand franchise, regulatory advantage, technological edge, network effect, and switching costs. We want our investee companies to fit one or more of these profiles. We also think or talk about how sustainable the competitive advantage is or can be to figure whether it will grow or shrink and over what time period.
That's interesting. But does this whole process leave enough on the table in terms of stock picks?
Generally speaking, no. I think it's a function of how much you're willing to dilute the thought process. On the competitive advantage part, that is, we try not to go beyond a point. I think we'll be able to justify competitive advantage in almost all companies we are invested in. Sustainability, maybe not completely.
Well, we have indeed, like you said before, seen quality doing extremely well to the extent that these stocks have clearly become quite expensive now. I remember reading a tweet recently which goes like this: the implied growth rates of Eicher, Page and Bajaj Finance seem to indicate that 5 years hence, every young Indian is going to ride an Enfield in jockey underwear bought on loans from Bajaj Finance.
Yeah.
But seriously, do you worry about valuations?
Yes, valuations definitely worry us. And I do think quality has gotten overpriced and it is a cause for concern. This could possibly lead to this fund underperforming over the next, I don't know, maybe 2-3 years. But to mitigate this problem, we are looking for companies where the economic moat is maybe not completely established, but is kind of emerging. But it's tough. The polarization is very sharp. Quality and growth premiums are extremely high. As a corollary, however, I don't think it is natural to switch to value or non-quality just because of valuations. Where valuations are attractive, leverage is high, or the probability is low, or growth is absent. So coming back to the risk of being invested or investing in this fund, while it may be tempting to time the markets, I personally wouldn't as a long-term investor, because what this philosophy does is essentially reduce the probability of going wrong or losing big money by focusing on strong business models.
Also, if I may add, isn't underperformance more of a risk if markets do very well from here, which is a moderate probability event, I guess?
Yes, so I don't know about markets, but yes, we've generally seen this kind of philosophy underperforming fast rising markets and outperforming flat falling markets.
So have you also been ever worried about the seeming inconsistency in the philosophy vis-a-vis your benchmark or even the broader mid-cap set? You know, India being a momentum-based market, have you ever thought about diluting it or changing it to suit market conditions?
So these are like two different questions. So let me answer the second one first. It's tough to run products to suit markets in the short to medium term because you don't know what markets will do in that period. It's actually as simple as that. So no, we haven't thought about changing the philosophy to suit market conditions. We'd rather alert the investor to the short-term risks. We actually don't recommend short-term investing to investors in the first place. On whether we were ever worried about benchmark consistency, yes. I remember early 2012 when the market rallied some 20% in just 1.5 months. We underperformed the benchmark by 14% in that short period. It was like the bull market had just begun and stocks, the junkier ones, doubled during that period. We were scared. Fortunately, the market stabilized in a different connotation. We were almost at par by the end of the year. So it's like this: if a stock has fallen 90% and recovers to fall, say, just 70%, it's actually tripled from the bottom, right? But then it is still fallen 90%. The philosophy that makes you buy the stock when it was 90% down would have probably made you buy the stock even when it was 50%, and then you would have lost 40% from there. So such philosophies are tough to sustain, or at least I would say we haven't figured them out yet.
Okay, coming to the portfolio, I've noticed that you seem to have strong sector biases. You've always been underweight financials and you seem to have a special liking towards consumer, especially consumer discretionary and industrials.
You're right, but I would say this is more an offshoot of the philosophy itself rather than any conscious bias. On financials, yes, we haven't been able to find too many stocks in the space that qualify our criteria on comparative advantage and return on capital. We've generally been pretty close to our risk limit on sector active weights here. And this is true for commodity stocks too. We don't buy them. Consumers, on the other hand, fit pretty well with the fund mandate, and we've been hitting the positive limits there. We've been like almost maximum overweight. The industrials overweight is a bit of a conscious effort to reduce portfolio valuations, as also to play the cyclical recovery in the economy. Most of these stocks are pretty well embedded in their sectors. They have niche competitive advantages. They've been going through a rough patch, but they'll have operating leverage kicking in whenever the recovery happens.
Just one last question. Where do you guys put your money?
Well, sans real estate, I've got some money stuck in an alternate flat. Most of my money is in mutual funds. All of the mutual fund money is with SBI, and I have money invested in Magnum Global too.
What about you, Anup?
Decode. Global has my largest allocation.
Wonderful. I totally love chatting with you. We hope all of you listening to us enjoyed this interaction. We'd love to hear from you. Look forward to speaking with you soon.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.